Welcome to a new episode of Inside the Economist's Mind. Welcome to the deep dive. Today, we're taking a deep dive into, well, a really important source, the Reserve Bank of Australia's May 2025 Statement on Monetary Policy. Think of this document as kind of the RBA's economic report card and crystal ball all rolled into one. It gives us a detailed look at what's been shaping the Australian economy and, crucially, where they think things are headed.
That's exactly right. These statements are pretty dense, packed with data and analysis, but they give you the critical context behind the RBA's decisions, their outlook.
Yeah.
So our mission here is really to cut through that density, pull out the most important bits, the key data, the big judgments, the major uncertainties, just to give you a clear picture of where the Australian economy stands right now, May 2025. The data cutoff for forecasts was May 14th, mean edition's May 15th, so yeah, very fresh.
Okay, let's unpack this straight away. The biggest headline, the thing everyone's talking about from this May statement, is the cash rate. What did they do?
The Monetary Policy Board decided to lower the cash rate target down 25 basis points, bringing it to 3.85%.
Right, a rate cut. That's significant. What was the main reasoning? Why now?
Well, the core judgment was that the risks around inflation had become more balanced. They felt that given what they expect internationally, developments weighing on the economy, and with inflation expected to stay around target, it was, well, appropriate to ease policy at this meeting.
Interesting. So even with inflation being such a big focus before, this sort of global picture was a really major factor here.
Oh, absolutely. The statement puts a lot of emphasis on the international scene, particularly trade policy. That's become a huge source of uncertainty since the February statement.
Okay, tell us more about that. What exactly has been happening on global trade?
Well, global trade policy uncertainty, it's risen substantially. The U.S. significantly increased tariffs, notably on China, the default rate hitting 30% on Chinese imports and other partners too. And there was some retaliation initially.
Right, so things ramped up pretty fast in early April. But then reading the statement, it sounds like things shifted a bit.
Yes, and that's where it gets really interesting. A lot of those U.S. tariffs were then reduced or paused, the stated reason, to allow trade negotiations. China also lowered some retaliatory tariffs. So while this meant a small dip in U.S. trade uncertainty specifically, the RBA's view is that overall global uncertainty, it's still highly elevated.
Got it. Elevated uncertainty, but maybe not quite full-blown trade war yet. What's the economic impact of all this, according to the RBA?
It's complex, naturally. The statement notes these tariffs and just the uncertainty itself are likely to weigh on global economic activity. Think of it like a negative demand shock.
A demand shock, okay.
Yeah, businesses, consumers, they get more cautious, less spending, less investment globally.
And what about inflation overseas? Does less global demand just mean lower prices everywhere?
Not necessarily. This is where it gets ambiguous. In the countries imposing tariffs, like the U.S., tariffs probably push inflation up near term as costs get passed on. But in countries not imposing tariffs, weaker global demand, that puts downward pressure. And it's a big but, if these tensions disrupt supply chains.
Oh, okay.
That could actually push prices up. So it's a real push and pull.
So demand down, but supply costs potentially up. That sounds messy. How are other countries' policymakers reacting? Central banks? Governments?
They're definitely reacting. China, for instance, is signaling a more expansionary stance, fiscal and monetary support, targeting around 5% GDP growth for 2025. Some European economies, Japan, Korea, they've also signaled looser fiscal policy. On the monetary side, some central banks, ECB, Bank of England, RBNZ, they've cut rates. They're citing progress on disinflation, but also, the weaker growth and uncertainty. But others, like the Fed, Bank of Canada, Bank of Japan, they've held steady. They see the weaker outlook, sure, but they're also wary that tariffs could raise inflation. So their approach seems more data-dependent, waiting to see how it plays out. And the statement makes a really key point here. Central banks know they face a tough challenge. You can't really offset weaker demand and tackle higher inflation at the same time if those tricky supply-side tariff effects really bite hard.
That really highlights the tightrope, doesn't it? How have financial markets digested all this, the uncertainty, the different policy responses?
It's been fluid. Riskier assets, like stocks, dropped sharply when the tariffs first hit in early April.
Right.
But they've recovered some ground as tensions ease back a bit. Globally, short-term government bond yields, they've generally fallen. That fits with markets expecting lower central bank rates because of that weaker growth outlook.
And the Australian dollar. It often acts as a shock absorber, right? Usually falls when things like shaky globally.
Usually, yes. It's been volatile, but interestingly, On a trade-weighted basis against a basket of currencies, it's actually a little changed since February. It did go up against the U.S. dollar in early April, which was a bit unusual in that risk-off moment, maybe tied to broader U.S. dollar weakness then. But it fell against other major trading partners. The statement notes, though, that if the U.S. dollar keeps falling during risk-off times, it could slightly dampen the Aussie dollar's usual shock-absorbing role. Just a nuance there.
That is a fascinating nuance. Okay, and borrowing costs here in Australia, how have they moved?
Well, following those global yield moves and the RBA's own rate cut back in February, short-term Aussie government bond yields have also come down. And that decline in the risk-free rate, it's generally flowed through to lower yields on private debt for banks and corporations.
Okay, so cheaper funding costs overall.
Mostly, yes. But the spread that extra bit investors demand for taking on risk, the premium over government bonds that spread for Aussie banks and corporates, has actually widened slightly. Now, this slight widening, plus the earlier dip in Aussie stocks, the ASX 200, is still down about 1.6% since February. It suggests maybe investors want a bit more compensation for risk, consistent with a slightly softer domestic outlook, although, these risk premiums are still pretty low historically. Corporate bond issuance did pause briefly in April, but it's back now.
Right, so market's showing a little bit of caution there. Okay, let's bring it right home now. The Australian economy itself. How did GDP growth look recently? Was it tracking expectations?
Yes, broadly speaking, GDP growth over the December and March quarters combined looks like it was pretty much as expected back in February. GDP grew 0.6% in the December quarter. Public demand was a key driver there. The NDIS, aged care, electricity subsidies, infrastructure spending.
Okay, public spending propping things up. But I saw a specific note on household spending. That's a huge part of the economy. How did that look?
Yes, that's where there was a slight miss. While household consumption did grow in December, the timely indicators suggest growth in the large quarter was probably a bit softer, around 0.2%, they reckon.
And they expected.
They'd expected 0.4% back in February, so a bit weaker. Could be things like promotional spending effects wearing off or just slower growth in discretionary areas. Might point to softer momentum. The statement also mentions the impact of the recent floods in Queensland and New South Wales, Cyclone Alfred, that temporarily hit activity in those regions. And the RBA's liaison, talking to businesses, suggests retailers are seeing slow to moderate demand and consumers are still very price sensitive.
That makes sense. Okay, what about the jobs market? We keep hearing how tight it is.
Labor market conditions, they've been steady, broadly as expected. Again, unemployment rate holding around 4.1%, still judged to be tight, although, pinning down exactly what full employment is right now is uncertain. Job ads are stable, but liaison suggests hiring intentions have eased back a bit from their peaks.
And there was that interesting data about job mobility falling, fewer people quitting. What's the thinking there?
Yeah, that's a really interesting point they flagged. Measures like the quits rate have kept declining, and that could suggest that competition between firms for staff poaching workers with higher wages might be easing.
Ah, right.
So it might imply a bit less upward pressure on wages than just looking at the unemployment rate would suggest. Liaison also says labor availability has improved somewhat.
Right. So steady headline unemployment, but maybe some subtle signs of easing underneath. What about actual wages growth?
Year-ended wages growth ticked up slightly, 3.4% in the March quarter. That was expected. However, they note underlying private sector wages growth is actually lower than a year ago. But growth in broader labor costs, like unit labor costs, basically wages per unit of output, that's still elevated. And that's partly down to stubbornly weak productivity growth. Labor productivity is still around its 2015 level, believe it or not.
Wow.
Yeah. Liaison contacts expect wages growth to slow gradually, maybe reaching just under 3.5% over the next year.
Okay, so even with wages growth, weak productivity means unit labor costs stay high, which can feed inflation. Right. Speaking of inflation, the big one, where does it stand now?
This was a key development. Underlying inflation, the trimmed mean, which smooths things out. It returned to the RBA's 2-3% target range, hit 2.9% over the year to March.
And that was expected.
Yes. Crucially, this was expected by the RBA. The slowdown's been pretty broad-based too, easing services inflation, falling new dwelling costs as builders offer discounts. Headline inflation was lower, 2.4% year-ended, but the quarterly figure ticked up a bit as some temporary subsidies unwound. And importantly, inflation expectations remain anchored within the target range.
Okay, underlying inflation back in target as expected. Sounds positive. So putting this all together, what's the RBA's baseline outlook now?
Well, based on everything, the baseline outlook is seen as a little weaker and definitely more uncertain than back in February. Domestic GDP growth is still expected to pick up, but at a somewhat more gradual pace than they thought before.
Why the downgrade?
It's largely down to that weaker global demand outlook, the increased international policy uncertainty weighing on things, plus that slightly softer momentum we saw in household consumption.
And how does that weaker growth translate to the jobs forecast?
Well, means the labor market's expected to ease slightly more than previously thought. Unemployment is forecast to drift up a little over 2025 before stabilizing early 2026. Employment growth is also expected to ease a bit more than forecast in February, though still positive, and wages growth is tipped to stabilize at a slightly lower rate.
And inflation in that baseline? Still getting back to target?
Yes, in the baseline, underlying inflation is projected to get back to and then stay sustainably around the midpoint of the 2–3% range by late 2026. The outlook for domestic inflation has actually been revised a little lower since February. That reflects their judgment that the trade conflict will probably be disinflationary for Australia overall, plus that softer domestic growth. Headline inflation might temporarily pop up in late 2025 as subsidies unwind fully, but then it comes back into the target range later.
Okay, baseline sounds okay, I guess. Manageable. But you mentioned significant uncertainty, especially trade. How do they deal with that?
Yeah, this is a really key feature of this statement, maybe more than usual. Given how unpredictable trade is, they don't just rely on the baseline, they use alternative scenarios.
Right, the what ifs.
Exactly, to illustrate the range of possibilities.
So tell us about those. What's the downside scenario? The trade war.
Okay, the trade war scenario. This assumes negotiations totally break down, higher tariffs stick permanently, maybe escalate. That triggers a sharp global confidence shock, asset prices fall further, global and domestic activity gets hit hard. In this scenario, domestic GDP could end up more than 3% lower than baseline by the end of the forecast. Unemployment could rise quite sharply, maybe nearing 6%, and inflation would slow right down towards 2%.
Wow, okay, that's more than 3% lower GDP, unemployment near 6%. What's the flip side, the trade piece?
Right, the trade peace scenario assumes a quick, comprehensive resolution. Uncertainty drops sharply. That, maybe combined with stronger stimulus overseas, could lead to a much stronger recovery in Aussie GDP growth and somewhat higher inflation than the baseline. And the statement explicitly notes that in this scenario, policy might need to be less accommodative than markets currently expect. So potentially higher rates needed down the track.
Which is a stark contrast to the rate cut now and market pricing. That comparison really shows how much hinges on these global talks. So pulling it all together, what does this deep dive mean for you, our listener?
Well, it really shows how these big global forces, especially trade policy tensions far away, are directly impacting the economic outlook right here. The RBA's rate cut decision isn't just about domestic inflation getting back towards target. It's explicitly about balancing those risks from the uncertain global environment against the domestic picture, which is, easing inflation, but still tight jobs and softer consumption.
Yeah, it affects your job prospects, your borrowing costs, mortgages, loans, how fast prices change, just the overall confidence in the economy. And understanding the nuances we talked about, like why job mobility matters beyond just the unemployment rate, or how trade affects import prices and export demand, it helps you make much more sense of the headlines and what the RBA is doing.
Absolutely. And the RBA is very clear. The outlook is heavily dependent on these unpredictable global factors. Those alternative scenarios really hammer home how wide the range of outcomes could be.
Which brings us to a final thought. The RBA mentioned that challenge for central banks if trade conflict causes and weaker demand. So the question is, how much capacity does monetary policy really have to support growth and fight rising prices at the same time in that kind of really tough environment?
It's a fascinating question, isn't it? Really gets to that inherent tension in the RBA's dual mandate price stability and full employment when faced with these complex global shocks.
Yeah.
Something to mull over.
Indeed. And that wraps up our deep dive into the RBA's May 2025 Statement on Monetary Policy. Hopefully you've got a much clearer picture now of the forces at play and the uncertainties ahead.
Yeah, thanks for joining us. Staying across these documents, it really does give you invaluable insight into the thinking behind decisions that affect all of us.
Join us next time on the Deep Dive for another exploration into the sources that matter.